Welcome everyone to this Friday webinar. Like any other Friday, this Friday also we have kept it, in a very insightful manner with Pawan from Equitree Capital. Just let me give you a few, introductory points about Pawan, which differentiates him, as one of the fund managers, particularly in the space of mid and small caps. Brings with him 25 years of experience, and also is a chartered accountant to begin with. But he is someone who believes in buying early and holding long-term bets. I have seen his portfolio since inception. There has hardly been any churning, and holding on to companies for as long as 10 years requires a private equity kind of an approach, which is something which differentiates equity capital. And that is where we thought of understanding from Pawan today broadly, is market conducive for listed space, to be seen from the point of view of private equity investing. We know that yes, private equity investments opportunities are there in the unlisted space because there are many new age businesses which are coming up across services, across manufacturing, across tech. But there are, I would say, plenty of fund managers in the listed space who are very skeptical, who always keep creating this narrative that small caps, mid caps are very expensive and hence sitting on cash. In fact, they are not able to find opportunities to invest even 30, 40, 50% of portfolio. Many are sitting even at, I would say, 70% cash. But here is a fund manager who has kind of built massive wealth for his clients in the listed space, adopting the private equity approach in the public markets. And because presently the narrative is something which I mentioned, that is where we thought to have you here. Pawan, welcome to this webinar. And we have aptly named the topic, and I explain it for our audience and for you to get the context. So first of all, we want to understand from you, where are we headed in this bull run? Are you agreeing with this broad narrative that there are hardly any opportunities which are like early, and we can see them kind of evolving as multi-baggers, evolving them as 10 baggers, which is what we kind of expect from a private equity approach when we invest as a private equity approach in public markets.
Thank you so much, Kamal, for having me over to begin with. Good afternoon, gentlemen. Yes, you're right. I mean, there are narratives going around that small and mid caps are expensive, and probably rightfully so in certain pockets. The problem is that these statements are generally looked upon as brushing the entire segment, and which is not exactly how it turns out to be. There are certain pockets of small and mid caps which still continue to be expensive despite the correction that has happened in the last 6 months. But having said that, there are still pockets of opportunities where there are excellent companies still available at valuations which are close to their 10-year averages and seeing extremely high growth. I think from our perspective, that genre of investing requires very ground-up investing where you are a little away from the noise and have the ability to go down and dig deep, where you can find ideas which are not commonly researched or commonly spoken about. And these opportunities lie in these segments. Obviously, the ones which are largely spoken about and spread everywhere, there the valuations remain extremely high even today. And even I will be skeptical to invest into those segments. But yeah, if you dig deep, there are enough and more opportunities.
So let's dig deep and try and understand from you, where are those opportunities and which are those sectors and those segments of markets which are looking, I would say, interesting. And then also understand, maybe with few examples, that how do you kind of execute the private equity approach when you see those companies?
Sure. See, from our perspective, Kamal, we are looking to play 2 or 3 large themes. One is the whole export opportunity. I mean, until I've been investing in the Indian markets for almost about 25 years, and I can tell you that there is a tectonic shift in the entrepreneurial mindset, which has happened over the last 10, 15 years, where earlier the Indian entrepreneur or the industrialist would generally look to be okay with a substandard kind of a quality product because he was not looking to compete in the global markets. I mean, maybe 15 years back, you would barely hear about a handful of small or mid-cap companies which would have any global presence. Today, the mindset is completely different and changed. Today, these small entrepreneurs or mid-sized entrepreneurs are raring to go global. One, because of course the government also is playing its role with the whole Make in India and all the kind of right things which are being done. Second, there is Europe plus one, which is playing out. People are talking about China plus one, Bangladesh plus one. Hopefully, that will also play out at some point in time. But even if I leave that aside, Europe plus one is definitely playing out. Where Europe, because of its own demographics, anyways, was going through a bit of a challenge, especially in the manufacturing segment. And that's turning out to be a great boon for Indian manufacturing. And these entrepreneurs are rising up to the occasion. I mean, today we are seeing even a 300 crore, 400 crore top line company is raring to go out and, either buy out European front ends or go and set up shops in America, where they're trying to compete with the global peers in terms of quality standards. Cost competitive, of course, we've always been. So that makes it a very potent combination. And that's the change that we are seeing today. All of us know that India barely has about 2.5% share in the global merchandise trade. If you look at the export composition, large part of it is oil and gas, gems and jewelry. Manufacturing, engineering as a sector contributes barely anything to the total export that India does. And that's where we are seeing opportunity. Despite one hears about the global slowdown, but our count is starting from zero. So even if you end up getting some market share, that still is a net surplus and significant scale that one needs to achieve. The other piece is on the import substitution side. So across different manufacturing and engineering components, despite everything else, I mean, for example, auto ancillaries. Auto has been almost a 6-decade-old industry in India. And you'll be surprised that even today, almost about 25 to 30% components are still being imported. And that presents a significant opportunity for anybody who can focus on the import substitution part of it. Because you straight away have a 0 to 100 scale available to you again, where you are doing any kind of import substitution. So those are the two large themes that we are looking to play out. Third is, of course, Indian demographic itself presents a very, very compelling opportunity, whether it be it domestic consumption or companies which are feeding into all of this consumption story, so to speak. And the last is, of course, the infra play. I mean, we've all seen in the last 10 years the way infra spend has been happening in the country and still continues to be at that breakneck speed. And a lot of infra ancillary companies, that's where we look to focus on. They are standing to benefit out of this thing. And the way the infra spend is happening is again significantly different than what it used to be 10 years back. And then that's what is making a great investment opportunity in this entire infra ancillary segment. So those are the pockets that we find a lot of opportunities.
Sure, Pawan. So, within infra, there is another segment which is being talked about a lot, which is defense, which has been kind of, I would say, talk of the town in, stock markets these days. What are your views in terms of, is it at a still an opportunity stage in terms of we expecting a lot of returns from here, or maybe a stage from where, one should kind of stay away?
I'm extremely happy to see defense getting its due share, Kamal. I've been a very early investor into defense segment as a private equity investor since 2001. So I've seen this space coming up very, very up close and personal. There indeed is a fantastic opportunity to play out in the defense, more particularly in the private sector where people are looking at export as a big opportunity coming up. Having said that, the recent sentiment-driven and liquidity-driven kind of stuff which has happened in a lot of those defense stocks has taken the valuation to another level. And that's something that we find it a little uncomfortable to pick up these stocks at the current levels. Because if you look at it, the entire pack is trading anywhere between 50 to 100x or maybe even beyond that. And having been an early investor into this segment, the experience is that while the order books are there, but execution takes time for multiple reasons. One, because there is physical challenge and limitation to how much can be executed. These are not, stuff that can be printed overnight and can be supplied. So there's a lead time for doing that kind of precision engineering and everything else. And you cannot do beyond certain point, even if you have all the other stuff being available to you. So there is a challenge in terms of execution. And from our perspective, we generally look to buy into businesses which are trading at less than 1 PG, which is price to earnings growth ratio. And that's something that we are unable to figure out that whether these companies will end up reporting, a 60-70% kind of a CAGR over the next 2-3 years. Because If they indeed do so, then probably the current valuations could be justified. But if not, if the growth were to be truncated at even 15, 20, 30%, then I'm not sure how long-term wealth creation can be done at these valuations.
Sure. So, coming on to the topic that we have kept, and we try to understand the practical and realistic aspects of following the, P approach to public market investments. It sounds very interesting because obviously, churning is something which in the PMS today, many kind of investors are wary of. And your portfolio, if it follows a buy and hold approach for long term, definitely it has its own pros. But at the same time, when we hear that market is cyclical, there are sectors that rotate. Not every bull run has same leaders. Every bull run has new leaders. And when you go through that cycles of markets in this cyclical manner, and you hold on to your stocks and follow P approach, following a P approach in an unlisted company is easy because there is no other option. You cannot sell it. But in public markets, you see many events happening and many risks unfolding, and many times stock kind of making new highs. So how do you hold your horses, and how do you kind of ultimately hold it for that long and ultimately end up as winner? And this is like question number one, and then there are many other, I would say, thoughts which I have on my mind. But if you could first address this particular aspect.
On a lighter note, we just try to stay away from all the noise. So my office doesn't have any CNBC or any other news channels that or Bloomberg or anything else. So yes, you are right that because it's a listed market, and because each one of us probably would be getting anywhere between 10 to 15 new ideas on a daily basis. So it becomes really challenging to focus and make sure that you're doing what is right for the investment. My experience over the last 25, 27 years of investing, Kamal, has been that there are 3 or 4 main fundamental characteristics to generate long-term consistent returns. And I'm breaking this up into long-term consistent, or probably putting more focus on that part, because it's very easy to generate a very erratic 1-year return and then probably see it going down and then again come back in the third year. My experience is that 90% of the investors, they don't really look at a 3-year, 5-year kind of a compounding. We look at market in the current, only from that year's perspective, and that year's result decides that how good an investor or how bad an investor you are. So from a cycle, from a theme perspective, that is where then you keep looking for that year's cycle, that year's theme, rather than looking at it from a long-term structural perspective. But if you break down, what are the key components to generate long-term sustainable wealth, there's nothing but the long-term sustainable growth of the companies. Because if a company has a structural runway where it can compound at 20-25% for the next 3, 4, 5 years, and you are able to hold the business for that long, you don't have to play the market or be worried about that what next theme is going to play out. The next theme will probably give you that 1 year's alpha, but next year you will be left looking for the next theme. Whereas a business which has a structural growth story of delivering a 20-25% growth, you don't have then to be worried about that what market cycles play out and what happens and what doesn't happen. If you are able to hold on to that growth for the next 5 years, ideally the market should also mirror the underlying growth in terms of its price and stock movement, right? And you should look to get at least a 20-25% returns on the investment. If that happens, then that's where you end up creating a multibagger. 25% compounding in 5 years probably roughly will get you to about 4 or 5x. That's what we look to do, and that's what private equity is. While it is easier said than done to hold on to this kind of investment, but what it requires is deep conviction about the promoter and about the business, because businesses don't work in a linear fashion. Here, markets would tend to punish your business if you don't deliver numbers for 1 quarter or 2 quarters, and probably the stock can see a drawdown of good 20-25%. That doesn't change the long-term structural story of the business. And there are times when that 25% drop probably could be because of the internal issues of the promoter. So from our perspective, what we emphasize on is to try and understand that what are systemic issues and what are unsystemic issues. If there is a non-performance because of systemic issues, which is impacting the entire industry, we're quite okay to live with that thing so far as a structural trend continues to be in a positive direction. It's an unsystemic risk, which is where we are very wary about and probably look to cut loss in that kind of a situation. I guess that's the big difference in being able to hold on to businesses from a long-term perspective.
Sure, Pawan, well said. So, given the current market environment, as we kind of begin, you mentioned that there are certain pockets which are attractive and you're focusing on those pockets. If you could take example of maybe one or two stocks and explain us that, at what level you entered, what was I would say market cap of that stock when you entered, and now, if how do you kind of handle the progress and the liquidity risk in the scenario of market fall? And I will give a disclaimer for the audience that if any stock that we kind of discuss, it is only to learn and understand your philosophy, your approach, because every approach has its own, I would say, expectations. And the audience out here is of investors who need to understand what they expect in terms of liquidity risk, in terms of concentration. And that can be easily understood if you take the example, of any stock that you bought maybe 3 years ago or 5 years ago. How did you kind of, see that business evolving, and at what market cap you entered, and at what market cap are you still holding it, and how is it today placed in terms of PE ratio, PEG ratio, and how do you kind of see it evolving from here onwards?
So let me take one of the companies which has been in our portfolio, and I guess a lot of our investors know us for that company. It was a company called Shakti Pumps that we had invested in almost about 7 years back. Now, when we picked up Shakti, they were the first company in India to come up with 100% stainless steel pumps. And back then, the pumps were largely made out of cast iron. So that itself was a game changer from an industry perspective. And while the domestic companies were focused on doing the business at 6 and 8% EBITDA margins, here was a company which was looking to export markets and operating at almost about 14-15% EBITDA margins even back then. Now, during the course of this last 7 years, we've seen enough ups and downs with the business, and multiple ones at that, because they pioneered this whole concept of solar-powered pumps. And as the industry picked up solar-powered pumps as a product category, while the business started twice over, they saw headwinds. And complete stagnation of the business happened because of completely external environment. And markets picked up in a manner that, okay, the story is now getting kind of over, and the stock decimated for obvious reasons, right? What we knew during both this while is that both of these issues that happened were completely external issues, got nothing to do with the business. So while the stock prices corrected almost about 40-50% during those tenures, we knew that because these are external issues and they will get corrected, and which it did. And as we speak today, all of those issues are completely resolved and settled, and this whole solar powered pumps is now a completely smooth project which is going on, and that's opened almost like a 5 lakh crore opportunity for the whole industry. Now, had we exited Shakti back then, when these issues hit them as part of the ongoing business, probably we would have never got to see a 40x being made on the initial investment. From a liquidity perspective or from a risk perspective, and you can probably relate to this thing as a private equity approach, where you're not looking at the stock price performance to really assess that whether a stock is good or bad, but just try to get deep into the business to understand and assess that what is the reason for this kind of a stock price movement to happen. And it could be both ways, down as well as up, on the higher side as well, right? On the contrary, because we had the conviction, we actually increased our holding during both of these times into the company. And that's what has led to this kind of a superlative performance. From a liquidity perspective, there are two parts. So one, it's extremely important from our own investors' perspective that the expectation is set right. So we take a lot of effort in terms of educating our investors also what to expect when you are looking at doing a private equity kind of an investment in the listed market space. And it's not out of context for our businesses to see these kind of volatility, because you are entering in very early and you're taking a business execution call that if a business were to be executed in this manner, then the upsides can be really dramatic. And that's exactly how Shakti played out. So when we started buying, we obviously had small positions in the company. We have been raising our stake in the company as the execution has been going along. Now, having been a private equity investor into this genre, it's always difficult and challenging in the initial phase when you are building up the position. But when a company matures, it's never difficult to sell that company. I mean, when we invested into Shakti, the market cap was less than about 300 crores or 400 crores. Today, it is close to about 10,000 crores. So at 10,000 crores, if I were to sell X percentage of the company with a 20-25% CAGR looking ahead, and the valuations being just about at 20x on current year's numbers, I'm sure it's not such a difficult thing to do. It's only about managing expectations in between and managing the liquidity in between. So if you have the right investor education and communication, then it's never a challenge.
Right, Pawan. So, understanding further on your portfolio construct, what are the kind of, I would say, sectors, particularly you are exposed to, like broadly index has 30 to 35% weights towards financial services. And I don't see financial services fitting in really well in your long-term approach, because financial services as a sector is very cyclical. So how do you kind of make your portfolio sector agnostic and avoid financial services, and again you still keep your, I would say, clients happy?
Well, like I said, for us, we are very ground up investors, Kamal. So our focus is largely on manufacturing, engineering, infra ancillaries. And when we look at businesses, these are very broad encompassing kind of words. So manufacturing could include, I mean, we have businesses which do apparel manufacturing, for example. And today, when the entire industry is talking of apparel because of the UK FT and everything else, we invested in this business almost about 3 years back when nobody was talking about apparel. But what we liked about this company at that point in time was that here is a business which is doing something different, completely backward integrated. That itself was giving them a significant mileage as compared to other competitors. Today, when the entire industry is talking about the whole opportunity, these guys are already working on almost about 85-90% capacity utilization. So even during the last 2-3 years, when the industry was not doing well, these guys have been able to at least maintain themselves in terms of their profit margins and everything else, which itself was a huge achievement when the market was seeing a downturn. Now, being that early investor helps in this kind of situation. So it's a very ground up investing that we do. Again, I go back to the same. So when you do that, today we are leveraging the benefit of that. I mean, the stock has already become 3x in my portfolio. And we are talking of now a significant jump coming about and so on and so forth. So that's the way we look at it. So manufacturing, engineering, we have investments in automobile companies. We have investments in casting businesses, which are very heavy casted products and so on and so forth. So the whole idea is that you look at a business ground up, spend a lot of time in understanding what are the contours which can lead to this kind of growth at a macro level in terms of addressable market opportunity, at a micro level in terms of companies' ability to execute and deliver that kind of growth. So that's what we have been focusing on.
Sure. So for new investors, who give kind of fresh check to you for investment, what percentage of portfolio is exposed to some of the existing businesses which have already kind of gone up by, say, 7 to 8x or maybe more? And what percentage are like very early where still the, I would say, growth in terms of multiple times is supposed to happen?
That again is, I think, a myth that people feel that something which has gone up 3x, 5x, or 7x is no longer investable. I think that's just the absolute stock price that one is talking about. From our perspective, the way we look at it is that, is my underlying growth still intact? From a particular point, do I still see that 20-25% growth visible? Because that's our baseline assumption. Second is my entry valuation reasonable at this point in time? I mean, assume if I would have not had this company in my portfolio, which is already at 3x or 5x or 7x, and I'm seeing it for the first time, will this qualify for making a fresh investment? If it does, then it doesn't matter that I've been holding and it's already become 5x and 7x. I think that's where a lot of people get into these kind of biases that, okay, if something is run up 5x, then it's not investable. Whereas if you think of it intuitively, I mean, from a business perspective, right? Any businessman, when he is building up his business, ends up investing more in the business when the business is actually showing signs of success, where you can multiply. It's only in the stock market where people tend to do it the other way around. That is, stock is performed, so just go out and sell. Rather than looking at more objectively at, okay, what do I have in store for the next immediate future? So the way we function is that anytime new money comes in, we look at whether my existing portfolio is equally investable. And that's how the allocations are decided. So we don't run a model portfolio allocation. In the strictest sense, model portfolio would typically take money today and tomorrow morning will end up investing in a pre-decided allocation. In our case, the allocations are decided at the time of getting the money. So probably in somebody else's portfolio, because it has become a 3x, 5x or 7x, by virtue of that, maybe the allocation could be slightly higher. And I may not want to expose the new incoming guy with the same exposure. So the calibration or the customization is only to that extent. But the portfolio may remain largely still the same.
So since
That's how the
sure, understood. Well put. So in the continuum process of managing the money, when you are like buying and holding your stocks, and what I understand that till date, in last since inception, you would have maybe done buying in broadly 40 stocks.
That's right.
So it's like, how do I make sure as an investor that the portfolio where I am being exposed to right now, these 20 stocks, these are not old stories. They have not kind of run up, and I will also be participating in that kind of a multi-bagger growth. Though I agree, you rightly answered that it is a myth that something which has gone up, cannot go up. But still, as an investor, before giving money to you, if you could give some more flavor without maybe taking name of stocks, but maybe some context of that these money stocks are there in your portfolio, where you feel this much growth is expected to come, and maybe in some other way if you want to answer this question. But the broad thing is that I want to understand, is the portfolio fresh enough? Because the portfolio is not going to see any change, or if you have a process that yes, two stocks get changed every 2 years.
Very valid question, and we try and address this thing every quarter through our newsletters. So if you go to our website, you'll find all of our newsletters, and in every newsletters we talk about that what kind of growth is expected in our portfolio from a business perspective. Because what will happen from a market perspective is not within our controls, but what is likely to be expected out of the business is something that we always comment on every quarter. As we speak, while the result season is on, up until for the first 9 months, our portfolio delivered almost about 19% year-on-year growth. And that's why we say that the proof of pudding is in the eating, right? When we're talking of this kind of growth coming about and we see the companies delivering, for the March quarter, out of the 15 companies that we have in the portfolio, I think about 5 of them have delivered about 25% growth. And that's what I'm talking about. That when you have businesses delivering this kind of growth, and to answer your question that how fresh is it in terms of macro opportunity or the road going ahead, whether this growth will be sustained, 3 of them have publicly given almost about a 35% conservative guidance for FY26. So that's the kind of growth that we're talking about. And when you buy this kind of growth at a reasonable valuation, and again, from our perspective, we look at valuing businesses on the current year's numbers. So we are in FY26. The way we look at our valuation is that what price am I paying on FY26 expected numbers. not FY27, which is probably 18 months from now. Most of our companies today trade at close to their 10-year averages, where my median valuation is close to about 14. And these are not commodity stocks or the PSU ones, which typically end up having low PE multiples. These are manufacturing businesses, these are engineering companies, which are available at 15, 16 PE multiples. So when you have this kind of multiples, which is closer to their 10-year average, PEG is 0.5, and we're talking of growth of about 25-30% in the foreseeable near future. I think that answers your question in terms of, the opportunity from here on in terms of being from a return generating perspective.
So currently your AUM is broadly 600 crores, and for a approach like you follow, which is buy and hold and entering early, holding for long term, is a large size of AUM or rise in AUM a bottleneck? And if so, then do you have any plan in mind that at certain point of time you will stop taking money because you don't ultimately want your performance to go down? Because I'm sure you have a very high skin in the game. It's a boutique, proprietary, transformed, publicly managed portfolio that you are kind of doing.
Yes, I mean, again, extremely good question, Kamal. We're conscious of that thing because this genre, if you have very, very large amount of capital, you will not be able to invest. Our sweet spot is basically companies around that 2000 crore market cap. That's what our sweet spot is. So if you come to think of it, for the large mutual funds or even for PMSs which are managing large amount of money, from their perspective, if unless they are looking to get scattered in maybe 30, 40 or 50 stocks, then probably they can look at having some exposure to this genre. But otherwise, in a concentrated portfolio, it's extremely difficult for somebody to have a 15, 20 businesses and do meaningful allocation in a 2000 or a 1500 crore market cap company. It doesn't work in that manner. So we are also conscious of that thing, and which is why we are looking to cap our fund. We operate in a PMS format, so current scheme probably will look to cap at about 2000 crore fund size, which is meaningful enough where we can buy deep into existing businesses. So today our stakes are between 1 to 3%. Ideally, we would probably want to go to at least about 3 to 5% stakes into each of these companies. And that can be easily achieved with that 2000 crore corpus that we are looking to raise. And at that, probably again, true to a private equity style, we would probably look to launch a fund 2 and then build another portfolio of 15 companies in the similar genre, rather than having excessive capital coming up in the same scheme, which then makes it unviable for us to focus in the same genre.
Sure, Pawan. So kind of trying to evaluate your performance while, if I compare your performance with the respective benchmark on last 1 year, 3 year, 5 year basis, it looks very good. Throughout it has outperformed, but the since inception returns are like very different. So this is something, which is coming on my mind when I'm seeing your numbers. I can see on my screen. Why is this, I would say, so much of a difference in your since inception numbers versus the 5 year numbers?
That's right, Kamal, and that's something that we've tried to address on our website itself. So that's part of our FAQ on the website. SEBI mandates us to report our performance on TWRR basis. And conceptually, the way TWRR works is that I have to report performance of capital that came in on day one and assume that no new capital came in and went out. And as of the reporting date, what the performance of that original capital is. That's how conceptually TWRR works. Unfortunately, in our case, we had two investors who came in on day one, and that comprised the initial capital. And of these two investors, one of them exited just after the COVID phase. Needless to say that exit happened at a substantially lower NAV, so to speak, and that capital was never available for us to recoup. And that's what has left a permanent dent in our reported since TWRR numbers. If I look at my other investor who still continues with us even today, their TWRR since inception stands at almost about 15% post fees and post expenses, which is over the last 7.5 years now. And this is after having gone through the COVID drawdowns and everything else. So yes, unfortunately, because we came from the proprietary mindset and we were not so smart enough to understand the marketing. Otherwise, the simplest thing for us would have been to close this scheme, come up with a new scheme, right? And this question would have been completely addressed. But we chose to continue with the same scheme because the same portfolio is what actually ended up delivering these kind of disproportionate returns that one is talking about.
Sure, Pawan. So, if I may understand your background, you had set this up Equitree in 2012, but
Correct.
formally you took the license in 2017.
So you're right. 2012, we set up Equitree. Suneet, who's my partner and a very dear and old friend, we set up Equitree just over a coffee conversation. I mean, we go a long way back. We've known each other for 30 years. So Equitree came into was set up, more like just to relive our hostel days. We thought that we'll manage our own prop book and exactly doing what I just explained to you, private equity approach to public market investing. It's just that one thing led to another, from doing friendly advices to close family and friends. We started realizing that a lot of third party references started coming in. And that's when then we said that, okay, if we have to do it, then we have to probably do it in a more structured and a meaningful manner, which is what led us to take the PMS license in late 17. So that's what the journey was.
Sure. Now the $1 million question: what are your views on markets? There are, I would say, so many fund managers that I interview every Friday, and it is very interesting to know. Today the views are like not everybody is having a same optimistic mindset, but it is interesting to know. What is your realistic mindset at this moment?
See, from our perspective, I think we will not see a broad-based kind of a rally that we have been used to for the last couple of years. Like I mentioned earlier on in the conversation, that valuations are still expensive in certain pockets. So if I were to segment market into three parts, let's say one is completely on the micro end side of the market, which is companies less than 200 crore market cap. There again, the valuations are completely obnoxious. Growth is not coming about, or even if there is very erratic, and so on and so forth. If I look at the other end of the spectrum, which is companies above 5,000-7,000 crore market cap and going up to large caps and those things, and probably within that also, if you were to segment, leave large cap aside and just say larger small caps and mid caps, there again growth has not been as what probably one would have expected it to. The valuations are not that reasonable. Those companies essentially saw a significant run up primarily because of the liquidity that came about over the last 2 years in a lot of the small cap PMSs and so on and so forth. Large caps, while they look reasonably valued, but growth is not there. So that's the way we are looking at this thing. In our genre, which is largely companies in that 500 crore to 5,000 crore market cap, and that's the segment where 43% of this genre comprises of manufacturing and engineering companies. And that's where we are seeing a lot of growth. So not just our companies, if you slice it down, then that genre is actually reported almost about 15-16% growth in the first 9 months, largely driven by this manufacturing and engineering businesses. And if you ask me, that's where we find a lot of opportunities. So from our perspective, I think it's going to be very, very stock pickers market. I don't expect broad-based returns or see a runaway kind of a return to happen. We may see bouts of good days followed by bad days, but broadly remain range bound till we see decent growth coming about. Everybody has been waiting for the growth to come about. Hopefully, we are seeing early green shoots of consumption revival happening at the rural level. So if those things come about and if we start seeing growth in the following quarters, then probably we could see more broad-based. If not, I think this is a stock pickers market.
Sure, Pawan. So do you also take cash calls? Like, this is another, I would say, question that a lot of investors would always have on their mind, especially when in our last 9 months markets have been range bound and they feel and believe and kind of expect some of the fund managers could have taken a cash call.
Yes, Kamal, we do. So we are not compulsive investors. We don't subscribe to that idea of investing that just because I have the money, I have to be invested. I think that's a very flawed way of looking at investing. Even otherwise, in the segment that we invest into, which is the small cap kind of companies, we understand that they are inherently volatile, whether good markets or bad markets. There is always volatility in the price, and the price behavior can be very erratic. Stocks could be up 5, 7%, 10%, and they could be equally down for no rhyme or reason. So we generally look to build a portfolio in a staggered manner. We tell our investors that probably we could take anywhere from 3 to 6 months to build the portfolio in a meaningful manner. Not because we don't know where to deploy the money, not because we lack confidence in buying out our companies, despite the kind of valuations and the kind of growth numbers that we're talking about. We're extremely comfortable to put money, but just that we know that this genre has inherent volatility. So we rather use the volatility to our advantage rather than getting played out by the market volatility. And which is why that staggered investing is extremely important. In fact, that's one of the reasons why in the last 6 months, where small cap index has been down about 20%, we are barely down about 6%. So the money which came in at that point in time at the peak of the market, we were almost sitting on decent amount of cash, and that cash has now been deployed as we saw corrections in the market. And that's how this genre of investing has to be done.
What's your view on gold? We have seen it growing, obnoxious to 1 lakh plus, but
gold did extremely well during last year, particularly, primarily because of the geopolitical issues that were there at a global level, right, from Russia, Ukraine to multiple other things that were going on. As we see a lot of these things settling, at least it appears to be getting settled, my sense is that probably we may see some technical correction on gold, which has already happened. I think gold is already off about 7% from the peak. But my sense is that we may see some stability consolidation happening at this thing. That's not a commodity which can consistently deliver 15% kind of returns on a year-on-year basis. Historically, if you look at gold, and if you average it out, that's not delivered more than 3 to 4% return on a yearly basis. There have been instances where 1 year returns have gone like even 15, 20, 18% or thereabouts. But on a long-term sustainable basis, that's the broad range. My sense is that given that last year we have seen this kind of run-up, we should see some bit of mean reversion happening in gold, and that will bring in some bit of consolidation.
Like your segment of the portfolio, which is like manufacturing and engineering, is growing at broadly 15%, earnings growth, as you mentioned. And because of your portfolio having concentration towards some of those good growing companies, and at the same time you took cash call, that is why your portfolio fell 6% versus small cap index, falling maybe 20%. However, let's talk about the, how will growth come? When the market fell, obviously you fell lesser. But now ultimately for next 3 to 5 years, for growth, for ultimately prices to go up, obviously one is earnings have to go up, but eventually the overall market mood has also to become, I would say celebration and euphoria oriented, especially because, you have a P style of investing. Otherwise, there could be one stock is going up and otherwise, other stocks are down. So returns will be like average. So from that point of view, where do we stand at the moment? Because investors idly try and make an endeavor to not invest, at a wrong time.
See, but there's no right or wrong time. I mean, all of us know that markets, can change very dynamically. Until probably a month back or so, we were at about 22,000. Just in about a month's time or 1.5 months' time, we are almost at about 25,000 plus. And nothing dramatic has happened except for a few clarifications which have happened more on the geopolitical side, right? The way we look at it is it's not in our control to assess that when the market mood is going to change. And when that celebration, sense comes about in the market to take the stocks, to maybe again a 40-50 becomes a more generic kind of a PE multiple. We are happy to be invested in businesses and see them compound. Only thing that we look at is that is the growth dependent on external capital? Because if my growth is dependent on external capital, more particularly equity fundraise, then I am exposing myself to these sentiment-driven market. If the market is good, I may get money to grow. If not, then I'm truncated. I mean, we know that in the last 6 months, we haven't heard of any great IPOs happening, any pref allotments happening, and so on and so forth. There were businesses which were dependent on this kind of external capital. Needless to say that their growth has got impacted and truncated. We are happy to buy into businesses which are generating good enough cash flows which can be invested for that consistent 25% growth, irrespective of the external environment. And as and when the environment changes, these are businesses then probably will be picked up by institutional investors. One thing which I would want to clarify over here, that when we say small cap companies, it's not that we are taking any kind of existential risk or we are buying in a 100 crore top line company with a 5 crore PAT or something of those kinds. These are businesses which would have been in existence for at least 2 decades and have a reasonable top line of close to about 1,000 crores. So these are fairly credible companies, just that they remain under researched, and because of that, they are underinvested by the institutional investors. So as these companies achieve scale in a manner as what we're expecting, they start attracting institutional investors and they get onto the guys. And that's where the next round of investors with far deeper pockets look to buy into these companies. And for us, that becomes a exit opportunity. So that's how the journey plays out.
Perfect, Pawan. I think it has been really pleasure conversing with you. I am quite convinced, and I will not bias my audience, by saying what are my views about the product. But at the same time, it has been really pleasure conversing with you. Most of these questions I had to ask because many of our clients want us to ask all these questions. But I really appreciate your patience, and I really wish you all the best for all who have attended this webinar or who may watch this video. Equitree Capital offers only one PMS with a minimum ticket size of 1 crore. They don't have an AIF. Equitree Capital is something which is a very niche product, a concentrated portfolio, not something which is, I would say, meant for everyone, and a style which is high on risk. And obviously, that's how one can expect higher returns. Hence, it requires a very deep understanding. So it's not something that you can kind of just look at the past performance of returns and do your investments. And past performance is not I would say, not to be construed as a future returns. So you have to understand everything and then relate it to your profile and investment objectives, and then take a call. There is a liquidity risk also involved, over and above concentration risk. And thank you so much, Pawan, for your time, and thank you everyone for joining us for today. Thank you.
Pleasure. Thank you so much.